that, I'm going to pass it on to John Wooters, Managing Director of the Georgetown Professional Alliances, to introduce Henry Fernandez. Thank you, John. I think you're muted, John.
Thanks very much, Rena. Certainly appreciate it. Henry Fernandez is MSCI's Chairman and Chief Executive Officer, as Rena had mentioned, and he has had this position for over 2 decades. And we may know that MSCI is the premier provider of indexes and portfolio construction and risk management tools for institutional investors. MSCI has revenues of over $1.4 billion and is listed on the New York Stock Exchange. Headquartered in New York and with 32 offices in 21 countries, MSCI is a central connecting point for the global investment industry. MSCI's clients are the world's largest investors, including pension funds, sovereign wealth funds, asset managers, mutual funds, ETF providers, hedge funds, and banks. Prior to becoming CEO, Mr. Fernandez was a managing director at Morgan Stanley, where he worked in emerging markets business strategy, equity derivatives sales and trading, mergers and acquisitions, mortgage-backed securities, and corporate finance. Prior to Morgan Stanley, he was president of private equity firm Hispania Media. He also founded Furco Partners, Inc., a private equity investment firm in Mexico. And from 1976 to 1979, he was a diplomat in the Nicaraguan embassy in Washington, D.C. Mr. Fernandez serves on the boards of directors, trustees at Stanford University, King Abdullah University of Science and Technology, Memorial Sloan Kettering Cancer Center, the Foreign Policy Association, and Catholic Charities of the Archdiocese of New York. Previously, he served on the boards of trustees at Georgetown University, the Trinity School, the Browning School, MEXDERG, which is Mexican Derivatives Exchange, and was chair of the advisory council at the Stanford University Graduate School of Business. Mr. Fernandez has a BA in economics. I'm noted to make that he is part of the famous class of 1979. He has received an MBA from Stanford University and pursued doctoral studies in economics at Princeton University. He was born in Mexico and grew up in Nicaragua. He lives in New York City with his wonderful wife, Alexia, and their 3 children. It's a pleasure to introduce my friend, Henry Fernandez.
Thank you, John.
Thanks, John. Appreciate that. Henry, I'm really looking forward to this conversation. We have known each other a long time. As I was building the NASDAQ information services businesses, I kept thinking, what would Henry do in this situation? So today is a great opportunity to ask him questions about what Henry did and what Henry is doing. Let's start off and talk a little bit about, let's talk about ESG specifically and MSCI. You have been in this space for a long time. It's a hot topic today. As Rena pointed out, G was always the hottest part. Now it's E and S. So what is the MSCI history? What got you into ESG and how do you approach it at MSCI, the whole topic of ESG?
So way back in the late 90s, when I was living in Europe and had taken over this cost center called MSCI at the time and trying to turn it into a business, a lot of our Scandinavian clients were calling us about how to create sustainable portfolios. And at the time, we didn't do much. So, we started sort of working with them and get their input and building indices that would reflect, their preferences of what they used to be called in those days, SRI, or Sustainable and Responsible Investing. So, so that was the start of it. And it took us a while because, we were owned by Morgan Stanley, and it was going to be hard to start rating corporate clients of Morgan Stanley on ESG criteria. So, so our real launch into this area started about 10, 12 years ago. At the time we separated from Morgan Stanley. And what we do today is that we are the largest provider of ESG tools to the investment community, starting with screenings, meaning when you look at a portfolio and you want to exclude companies, we do all that research, to ratings. We rate about 20,000 issuers nowadays and counting, to ESG indices, and risk models for the measurement, to measure the risk profile of portfolios. And we do this in equities, in fixed income. We have started doing climate value at risk in real estate portfolios, and have started a pilot project to start rating private companies as well. So that has been the evolution of this for the last 12 years. And we believe very strongly on sustainable investing for a lot of reasons that I'm sure we'll get into.
That's great. Thank you. So it sounds like the Nordic investors in the Nordics and the Baltics, or the Nordics, started driving with demand. So how has that changed today? How are institutional investors looking at this market today? And what's changed about what they're looking at?
So it has dramatically changed, because basically the whole sustainable investing process has gone mainstream. And we had, from the early days of our development, we wanted to make sure that that will happen. We didn't want to be in the periphery of this. We wanted to bring ESG investing to the mainstream of all of our clients and the like. So right now, it's only a question of who is leading and who's lagging, who is in denial, or who is embracing a lot of these trends. But it is for sure a big part of the mainstream process. And as such, it's going into the clearly equity portfolios. We're increasingly seeing it in fixed income portfolios, and for sure there is a lot of dialogue in the private asset classes and the like. So that is what's happening. It started. Actually, it didn't start only with the Scandinavians. It also started with Catholic and other values-based investors, in which they wanted to create a portfolio reflective of their values and their principles. And then obviously the Scandinavians took it up, as more of a societal, impact, and then eventually got into the mainstream.
That's great. So how have you seen the regulators' approach change? I mean, it must have, it's always driven by investors first, and institutional investors and institutions. And so how do regulators look at ESG? How did they look at it? How are they looking at it today, both Europe, US, and you're a global company? So any other insights?
So John, I think this is, even though it's going mainstream, it's still early days of ESG incorporation, or what we call integration, into portfolios and into the behavior of companies and other forms of issuers, like debt issuers that are not companies. And therefore, there is quite a lot of different measurements, different criteria, different data sets, and at times, it can be confusing. And as such, regulators are trying to put their arms around this and say, what are the regulatory requirements that they can impose on investors or on companies, but appropriately so. They're starting cautiously, because they given the early stages of development of a lot of the data, a lot of the ratings, and a lot of the information, it is even hard for them to try to legislate, what should be the exact requirements of an evolving field like this. A lot of what we do in ESG, when we rate companies, for example, has to do with materiality. We focus on what is going to be material to the performance, to the financial performance of that particular company or that particular issuer. So there are a lot of interpretations of materiality too. There is not a wide band, but there is a lot of areas in between. So therefore, regulators are starting to ask for disclosures, as opposed to for specific metrics. The Financial Stability Board has been under Mark Carney at the time, was one of the leaders in providing this on what is called the TCFD proposals. And so the regulators are beginning to get into that, and especially on trying to get companies on a voluntary basis to disclose a lot of the information that will be needed for investors. At think eventually, as the funnel gets narrower with respect to what is material, what is not, what is relevant, what is not, I think we're going to start seeing even more regulatory requirements in this area.
That's really helpful. One of the things that we've heard is that investors of all shape and size are concerned with companies, later what you're saying, greenwashing, in that they're trying to position themselves in the best light possible. And it's hard to cut through that to find out what's real and what's not. And I think materiality is a threshold. So obviously you guys are a data-driven organization, applying screens, looking at the details. How do you deal with that? How do you sort through all the different ways that companies are self-reporting or issuers are self-reporting?
So that's a great question, John, because what we do at MSCI when we rate issuers is we take about half of the inputs or half of the data sets to arrive at a rating comes from company disclosures, either reports to a Securities Commission or what is in their website or their annual report or their press releases or other form of marketing material. The other half of the input that we take is from third-party sources that are relatively independent, from the company. So, for example, in social issues, we canvass all the courts of law around the world and where the company operates in order to understand what kind of lawsuits have been applied to that particular company. For example, we look at environmental agencies around the world to see what fines are company getting on environmental issues and the like. So we canvas as many data sets in the world as we can, and we do this with extensive amounts of technology and data management. This is an area where we apply the most artificial intelligence and machine learning in order to save on having to have so many people do this. And then we summarize that information for the analysts that are looking at a particular rating based on a methodology. So that's one area that we do. So therefore, in the context of that, it is very important to know that companies are going to put their best light forward in what they do, and we do that. Now, the other thing, we take that into account, but we also want to compare that to the independent verification of that. The other thing that we do is before we create a rating for the company or the issuer, we send all this data to the company, and we ask them to review it and to tell us where they believe we're not right, where they think there is additional information, and some of them do that. Now, some of them may want to give us, private and confidential information, and we don't accept that because all of our ratings, we wanted it to have them on public information. We don't want to have any kind of inside information about a particular company. So I think that process, it started with very, very little input from companies. About 3 years ago, that number was about 17%, 18% of companies were engaging in trying to help us verify the data. By now, we are over 50%, about 52% of the issuers that we rate are responding to checks on the data, and that's going to increase because obviously a lot of these ESG ratings and ESG indices are going to determine asset allocation by investors around the world, and there will be repricing of financial assets on the basis of this that will affect the cost of capital of companies.
So that last point is something I want to touch on now. So it's been said that in the past, investors with into ESG were willing to take a lower return to do the right thing. But I don't think it's the case anymore. I don't think investors are willing to accept a lower return. They want to see the same or higher return because a sustainable or a company run with good ESG practices should be a more sustainable, better run business over time, and their employees want it to be so. Is that the case? Do you find that to be the case today?
Absolutely. As I said before, John, the values investors were willing to take maybe a lesser return to build their portfolios on the basis of their principles. But the mainstream investment business, you will be violating fiduciary responsibilities if you're taking lower returns in order to be a social agent or an NGO in the world. That's not their mandate. Their mandate is to maximize the short, medium, and long-term financial returns on the portfolios that they hold. So therefore, we've done extensive quantitative analysis about the differences of portfolios that are ESG compliant and the ones that haven't. And for sure, there is an outperformance in those companies and in those portfolios that have that adhere to very safe and prudent, ESG criteria. So I think that is going to continue. That differential is going to get even higher because society's preferences are going to be even higher and more demanding. Society is going to demand, better diversity and inclusion in companies. They're going to demand, better protection of the environment. Of course, the longest one has been better governance of all institutions in society, not only corporate, whether it's religious, universities, whether it's political or media. There is a lot of demand of society on this front. One other thing that I'd like to say, which probably I should have mentioned at the beginning, is that ESG is a natural progression of capitalism. As we know, capitalism is a giant allocation of resources in a society, from savings to productive investments to create economic growth. But we also know that capitalism throws off externalities, things that are not priced into the market of assets. And the reason they don't is because there is not a lot of information about those externalities. So ESG is a process of internalizing those externalities, making the data and the information available so financial agents can internalize that process and reprice assets in a way that creates a better allocation of assets from savings to productive investments without, for example, corrupting the society, or without creating damage to the environment, and without having sustainable governance of companies.
So that's a great point. And I think what's interesting is we've talked about institutional demand for ESG analysis and data and information, and the regulators and the policymakers. And there's a third constituent that is interesting, because more and more we hear about employees of companies who want to work for a company that has a good ESG track record. So management of companies is getting a third leg or a third way of getting pressure to be ESG. That's the kind of company they want to work for. So can you want to comment on the employee aspect of it?
Yeah, so when you look at one definition of capitalism, which we call stakeholder capitalism, you have those three constituents. You have the customer, you have the shareholders, and you have the employees. And within the employees is the community, because they live in a community that you operate in. So what is increasingly happening with ESG and sustainable investing is, for sure, the customers are demanding that they buy products from companies that are responsible, to society. Shareholders are getting more and more concerned about their financial investments in companies if the company is going to get caught on a discrimination, or a hostile work environment, or polluting a river, or whatever. And the employees are also an increasing force. We see that in Silicon Valley with many of the technology companies. There is employee activism, if you want to think about it that way, in a lot of companies, in which employees are beginning to demand that companies operate in a sustainable way. And if you don't, you're going to have a lot of employees internally that will be on strike, quote unquote, or putting a lot of pressure on the management of those institutions, and or you will not be able to attract the best talent in a society, because of that. We have been very fortunate at MSCI that because we've been a leader in ESG, we've been able to attract quite a lot of employees that they specifically, in our surveys of our employees, say that one of the reasons they want to work at MSCI is because of our efforts on sustainability. So that's a direct result. Also, when I have town hall meetings and other employee meetings on diversity and inclusion, for example, I get a lot of questions about what is the number of employees that are women in our company, that are Black, that are Latinos, that are different genders and the like, and there is a lot of pressure on employees, and they want answers. They demand that we that we are transparent about all of that. So this is happening definitely all over corporate institutions, other issuers, and also throughout all other institutions in society.
Thank you. We're starting to get some great questions from the audience. The first one is, compare and contrast the U.S. to other countries and regions of the world, the whole environment of ESG.
Yeah, so I think in the U.S., there was always a long tradition of governance. As was mentioned before, and now there is a choice as to how much effort it will be placed on us or on the environment. And I think compared to other regions of the world, especially Europe, there is a much bigger emphasis on social issues in America. The Me Too movement, of course, the Black Lives Matter and all the racial injustices that have taken place. And a lot of it is because America is gradually becoming a multicultural society. And therefore, as such, to garner the power of America, it is to be able to include all those people, in an effective way. So I think the social issues are beginning to dominate quite a lot of the ESG discussion in America. Now, right behind that is obviously climate change issues, but I think there is still a meaningful part of America that is in denial about climate change and the impact of climate change, in the world, in the economies of the world. That is changing, but compared to Europe, there is a lot more, much more awareness of environmental issues in Europe. In Asia, quite a lot of the focus is on environmental issues. In places like Taiwan, I would say in China, because of pollution in the country and the like. In the case of Japan, for example, there is a lot of emphasis on social issues, particularly as it regards to women in the workforce. A lot of it makes sense. Japan is a shrinking population country. In order to create economic growth, they need a lot more employees. They need a lot more people contributing to society. And unless they get a lot of women in Japan into the labor force, they are going to see lower economic growth in the future. So those are the differences. I think over time, there will gradually be a convergence of the issues. But I think at this point, we have different speeds of the different elements in the various regions of the world.
So we got a specific question on sub-Saharan Africa, and it must be a challenge to get data on companies in that region as you do your analysis. So how do you handle that, and is it a challenge for? It's a challenge for you, but also for the people who use your products, and how do they in fact deal with the fact that there is a dearth of information from African companies?
Yeah, for sure. When you look at a developed market like the US or the UK, France, Germany, Japan, Australia, we are going to find a lot more company provided information, for example. But you will be surprised, how much information exists online and in environmental, agencies or courts of law and other, in blogs and other places in sub-Saharan African companies. Or even in companies in other emerging markets, whether it's the Middle East or China or other places. So yes, it's a challenge, but we get enough to be able to provide a good rating on companies on the basis of all of that information that we receive. And obviously, we continue to look for additional sources of information in order to improve. But a lot of these emerging marketplaces, bear in mind that they're also by-stepping or the normal flow of information. A lot of the societies are a lot more mobile because they basically by-step in the wire lines and all of that. So there is a lot more social media in some of these places relative to the traditional media. So that is something that we're taking advantage of.
Great, thank you. So as I've watched MSCI over the years very closely, professionally and personally, I've noticed, you have one of the world-leading classification systems for issuers. It is no surprise how important it is when MSCI decides a company is no longer emerging and needs to be moved to develop, or a country is emerging versus developed. It has major impact on the market. You have a huge experience now in ESG, and we talked about there's no standards. Should that standard be something where the market just starts adopting, the MSCI standard because you're world leaders at this and you've done this for so long? Or do you see pressure from policymakers and regulators that they're going to set up a standard or some other body? How do you think standardization is coming, and is it going to be driven by the regulatory a broader market initiative, or people are just going to adopt best practices such as MSCI's?
Yeah, so let's compare the ESG ratings to credit ratings. If you go back in history, John, and you look at the evolution of credit ratings, they were not as homogeneous between the various rating agencies at that time than they are today. There was a lot of different information. Even today, when you look at credit ratings in an emerging market like China, and you compare those credit ratings to the three big credit rating agencies, there are huge differences because they're evaluating different things, at the time. Now, there was eventually a convergence of criteria on credit ratings that we see today, but that took some time, to get there. And credit ratings are, they're measuring one thing, which is the probability of default of a company. When you look at ESG, we're measuring a lot of things that are material, but it's still a lot of different things. So I think there will always be an element of differences in the different ratings. Now, I think this is a process that it is probably best left to the market, forces to determine. I mean, because you tend to think, what would the regulators know more about how to create an ESG rating than a company like MSCI? This is what we do every day. We have 350 people doing this, at MSCI. I think what the regulators will step in a big way is gradually is the forcing of the disclosures about the things that will be important in those ratings. And they are approaching that right now. They're trying to do that and the like. So I think it's going to be like anything in a new area. There's going to be a lot of market forces, a lot of innovation, a lot of different experimentation as to what works. And my advice to companies and investors is, you cannot use an excuse that just because this is a moving target that you cannot start implementing a lot of these policies. You have to look at the data that exists, the ratings that exist, the indices that exist, and start moving in that direction. And over time, the things are going to get more and more fine-tuned.
Right. I'd like to switch gears a little bit and follow up on a point you made earlier, which is in this environment, ESG obviously there's a heightened sensitivity on ESG with the COVID pandemic, with the recent inequality and racial justice issues coming to the forefront, climate change, et cetera. So how do you see that impacting, and how has it impacted you as running a huge multinational company? As you mentioned, you've got 32 offices in 6 continents and thousands of employees, et cetera. How are you as the head of that company and dealing with that, and how's it changed your customers and your employees and so on? So let's talk a little bit about the current environment, 2020, very interesting year.
Yeah, so John, we at our company, in our own internal focus, are a microcosm of what companies need to do to respond to this to a lot of these issues. And it's not just to say, let's give the investors what they want in order to pay lip service to what they're looking for. No, there are a lot of things that are embedded in what we all need to do, that should be embedded in what we all need to do in order to manage a better company. So the first one is, what is your position on the health and the well-being of your employees and their families? So during the early days of the pandemic, we have always made a choice at MSCI that the safety and the well-being of our employee is job one, number one. You don't do that, you should not be in business, because you're not taking care of your own people, and your own people cannot take care of your clients, and the clients and the employees cannot take care of the shareholders. Very simple equation. So there are a lot of companies that, we're not in that category. There are a lot of companies that view their employees as just raw material to what they do. That is beginning to show a differentiation in the world. The second thing is, okay, how are you going to equip a lot of your employees to working remotely? During the COVID pandemic, and therefore we had already an advantage because we're a global company that has so many people working virtually and in teams around the world, but we still had to mobilize quite a lot. So for example, before the pandemic, we probably had less than 20% of our employees with laptops. So we mobilized dramatically to provide laptops to our employees, to provide all the equipment, or, you know, if they needed a desk in their home and things like that. You know, if they needed help in talking to their internet provider to make sure that, you know, they had the right connections and all of that. So the office is no longer confined to the four walls in your office space. The office is now, you need to have, you know, a role to play on a community in which you have a lot of people, and what is the internet service provider doing in that community? You know, another example of that. Then what are you going to do with your clients? What are you going to help them with respect to all of this? So I think that when you look at, you know, and then, you know, obviously the racial injustices took place, you know, in America, and therefore you say, what is the role of corporate leaders with respect to speaking about these issues? So I personally went, you know, inside the company with a large number of you know, town halls and meetings and discussions and emails and about, you know, these injustices, and that we could not live in a society like that. And this is not about socialism or communism. This is about human decency, you know, about how you treat people in a country and in a society. So therefore, you know, I decided to publish all of that, you know, which I'm trying to be more of a private person, you know, but I said, no, I'm going to publish this in LinkedIn and in Twitter and other places, just so that people realize that, you know, what is it that we're doing in one company, and hopefully that will be an example to others. So I think what is happening here is a major accelerant. A lot of the things that we're talking about, we're already there. What is happening in 2020 is a major accelerant of a lot of things. We have 3 or 4 crises, obviously, in 2020. We have the health crisis, the economic crisis, the racial crisis, geopolitical, you know, problems, obviously, and all of that has combined to make 2020 a milestone year. We're going to remember this year as the year in which there is a huge accelerant of a lot of these issues. Now, the big elephant in the room is clearly climate change, right? So the question then becomes, you know, if World War III, you know, against an invisible enemy, which was the pandemic, was not very well handled by the allies, so to speak, you know, in fighting this war. Imagine what will happen if we have a climate event. So I think that is a wake-up call, and therefore we are going to see an acceleration of climate change initiatives and climate change focus, you know, because of that, because of what happened in 2020 with the pandemic.
So great, interesting. I appreciate those insights. So before we went live on camera, we were talking backstage, and you mentioned that your travel schedule is different than it's ever been in your career, right? I mean, there isn't one, right? It's very, very small. But you managed to reach employees more, you think, and more effectively in this environment. You've been able to conduct more town halls virtually than you could in person because of 32 offices scattered around the world. So how do you see that changing when there is a effective vaccine and we have a good distribution and better therapeutics and all that kind of stuff? We will get to the other side. How do you see the business model changing, or do you see it changing, or is it going to go back to where it was, or is it going to change? What's your view of the future of business? So,
John, to begin with, I think that this major change in the way we work, in the way we relate to clients, and relate to other, has been a breakthrough change. You know, obviously in the context of a lot of suffering, you know, with so much precious loss of life and so much economic pain and the rest in the world. But it came, and therefore we need to take advantage of these changes. You know, we have woken up and realized how incredible is the level of communication that we can effect, you know, virtually, without having to have, you know, travel around the world or having to have a physical presence, you know, among people. And I think that there's clearly a lot of complaint about it because we're so used to an in-person world. But I think my advice to the audience, and the same thing that I do with our clients and our employees and our friends and our family, is when you look at the ledger, the assets or the pros associated with this virtual world are a lot bigger than the cons or the problems. So as we, you know, re-enter a more in-person world with vaccines and and reduction in infections of COVID, I think you're going to see a hybrid. But the spectrum is going to be all over the place. I have friends of mine, CEOs of companies, in which they can't wait to have every single person back in the office. Can't wait. And that reflects their way of doing work and the way they think and all that. I have other CEO friends that are the other extreme, which is they say, no, this is fine. I'm, particularly in Silicon Valley, I can have 70, 80% of my people working remotely. I don't need to have them all in offices. So I think what you're going to find is a wide spectrum of people. There won't be any convergence. There will be a wide spectrum. And maybe over the years, that will converge somehow. So, in our company, we'd like to have it at maybe 20, maybe 70, 30, which is, 20, 80, 70, 80% virtual world, 20, 30% in-person world. We're beginning to redesign all of our offices to reflect that, putting a lot of technology in the hands of our employees around the world to reflect that. But other companies were going to be 20, 30 or 0, 100, meaning everyone has to be back, in the office. So I think we're going to see a wide spectrum of that, and a lot of experimentation, a lot of trial and error, and that's going to be fun too, because we will find the positives of that world and the negatives of that world, and we will all learn together as to what works and what doesn't.
Great, thank you. I share your insights. I want to switch. You mentioned speaking to the audience. I want to ask some questions specifically to a certain part of our audience, and that is the students. You've been involved at Georgetown in every different way. We appreciate that, and a few other institutions as well. So I know that you're very focused on young people and their success. So two-part question. First part is, what's your advice to students who are in the undergraduate process right now? School is changing, and I know that some of it's online, and there's every kind of model out there, depends on the school. But given where you think business is moving to, the model's moving to, what do you think they should focus on in school? What should they add? What other skills and techniques should they add? First part, and then I'll come back for the second part. So start with that.
So first of all, don't fight what happened to us. So the pandemic came, we don't deserve it, we didn't welcome it, we don't want it, but it is here. So then you got to flip immediately. You got to say, how do I take full advantage of this period? And, and there being so many discoveries, so many personal discoveries, scientific discoveries that have taken place in periods like this, because people had to live differently and think differently. So number one is don't fight it. Just look for all the positive that you can obtain in a world like this. And when the world returns to normal, you'll go back and do some of the other things that you were planning to do. Number two is that, even in the context of this, reach out to as many people as you can, because it is a lot easier to reach out to people virtually than physically. I have reached out to many, many more clients of MSCI, more by far than at any other period. I've reached out to so many more employees of MSCI, more than I've ever done. Through a virtual world. It's a democratizing process, and everyone is within reach, because it's with Zoom or Teams or something. Then, the next recommendation is, what are the areas that I think you need to be exposed to? I believe that two of the biggest industries that are coming, that are already here and are going to be a major part of our society, are high tech and biotech. So if you do not have some level of knowledge and understanding about high tech, for sure, everyone knows that, but also biotech, biotechnology, biopharma is going to revolutionize the world. So you need to have a little bit of an understanding of that, because that's going to have a major impact in your world. Another area is geographically is Asia. Is clearly the largest region of the world in terms of population, economic growth, for sure. And obviously China is the giant of Asia. So you need to have a big familiarization of what's going on in Asia, what's going on in China, because what happens in China is going to have an impact in your world, as a student now, and obviously in your, going forward. The last thing that I will say with respect to this is, when I go back to my undergraduate days, and I go back to my career, the one thing I always regret is, why didn't you take more risk? Why didn't you follow your passion more closely? Why didn't you speak up when you had the opportunity to speak up. So all of that is my advice to you is follow your passion, take risks in your life, calculated risk, obviously not crazy risk, and stay very close to that and speak up when you have the opportunity to do so.
That's great advice. Actually, I think we'll leave it on that note, and knowing that I have a lot more questions, so that means you have to come back. So we'll look forward to getting you back here at a Georgetown event for the center in the future. So I just want to thank you very much for speaking. Thank you very much for joining us and giving us of your time and your insights. It's been extremely valuable, and we will talk to you soon. Thank you very much. Appreciate it, Henry.
Thanks for having me, John.